Stanton. I want to welcome you to another presentation in the Valuation Masterclass Bootcamp. So, are you ready to present?
Yes, I am.
Okay, I've got your presentation up here. So, what I'm going to do is I'm going to exit. And when I exit, I'm going to tell you so, and then you just start. Okay.
Okay.
So, I'm exiting now, and you can start now.
Okay. So when you hear about Chevron, what comes to mind? Is it oil rigs, gas station, or the buzz about green energy? Now, navigating a future where oil remains that dominance. Good day, everyone. My name is Chiamaka Ekoreke, and I'll research report on Chevron. I initiate coverage on Chevron with a buy recommended price of $215 implying an upside of 36%. I derive my target price from a free cash flow to the firm-based valuation using a weighted average cost of capital and a terminal growth rate of 1%. Chevron powers growth with strategic expansions, clean energy strategy unlikely to drive significant revenue growth, impact of renewable transition challenges on EBIT margins, major risks, volatility in gas prices, uncertainty in transition, rising capex and cost challenges, regulatory and environmental pressures. Now let's talk about the company background. Founded in 1879, Chevron Corporation is a US multinational operating in 180 countries, holding over 3% of the global oil and gas market and 12% of the US market. It ranks among the top 3 US oil companies with primary revenue from US operations and significant activities in Africa, Latin America, and Asia, alongside major production facilities worldwide. Let's talk about my 3 key stories. 1. Chevron powers growth with strategic expansion. Chevron is driving growth in Africa by developing infrastructure in Nigeria and Angola, focusing on offshore wind and solar power. Partnering with USAID and Power Africa, it projects 10% annual growth in African operations, which is expected to contribute 5% to total revenue over the next 5 years. Simultaneously, Chevron anticipates the Hess acquisition will add 400,000 barrels of oil equivalent per day to production, enhancing its presence in Guyana, a key oil growth region. The acquisition is expected to improve gross profit margins through synergies like operational efficiencies and economic of scales. However, initial integration costs, including system alignment and workforce restructuring, may temporarily offset these gains. With this initiative, I forecast Chevron's revenue would grow at an average annual rate of 7% over the next 5 years. Clean energy strategy unlikely to drive significant revenue growth. According to the International Energy Agency, global renewable energy demand through 2030. $10 billion to hydrogen and carbon capture, targeting the $2 trillion clean energy market. However, the strategy faces challenges. Carbon capture accounts for just 1.4% of global energy investment, hindered by high cost and slow technology. Hydrogen infrastructure remains underdeveloped, limiting the investment represent only 2% of total capital, signaling a cautious transition. Competitors' more aggressive strategies contrast with Chevron's slower pace. High capital costs and market uncertainty further add risks. I forecast Chevron's renewable investment will contribute less than 5% of revenue by 2028, far below the 20% target necessary for substantial impact. Impact of renewable transition challenges on EBIT margin. In 2023, $1.8 billion in the devaluation of assets, while limited renewable investment opportunities. Without scaling renewable investment, I have investor confidence over the next 5 years, reducing annual revenue by 2%, raising the cost of capital, further squeeze margins. In the short term, I project 7% in 2023 to 9% by 2025, mainly due to high cost, limited renewable progress, and in the long term, failure to scale renewables will result in pressure. I'm going to give you a quick overview of the oil and gas industry. Even though there has been a big push towards renewable energy sources, oil and gas still plays a major role in the global energy supply. Industry continues to dominate the global energy landscape, which is divided into 3 mainstream, the midstream, and the downstream. According to Market 2024, as you can see at the top right-hand side graph, it grew from 7.2 trillion US dollars in 2023 to 7.6 trillion US dollars in 2024. Of 6%, and it's projected US dollars by 2028 at an annual growth rate of 5%. The graph also shows that the oil and gas market is growing steadily, and this demonstrates that the oil and gas industry will remain stable. But despite its growth, there are evidence of increased investment in low carbon energy sources. Bloomberg recorded that last year there was a cumulative investment of 1.1 trillion US dollars, which equaled the investment towards fossil fuels for the first time. This heavy investment signals the growth of renewable, which is expected to disrupt, if not wreak havoc, on the current dominance of oil and gas. However, I believe that the oil and gas will continue to sustain developing economics despite green policies. Now let's move to my numbers. I must state that I incorporated my stories into my model. So yeah, quarter of 2024 highlights a sharp decline year over year. Net profit saw a sharper decline, falling 31% year over year as rising operational expenses and lower energy prices weighed on profits. So let's talk about the consensus estimates. This is done by of industry analysis. 8% of analysts recommend either a strong buy or buy, while 33% have a neutral hold stance. The mean target price suggests a potential upside of 7.3%, rising from 158.72 US dollars to 170.26 US dollars. Revenue growth is expected to recover from a decline of 16.5% in 2023 to positive growth of 5.3% in 2026. I kind of agree with their estimates. So Chevron revenue breakdown highlight downstream dominance. In 2023, Chevron earned a revenue of 196.9 billion US dollars, marking a decline from 235.7 billion US dollars in 2022 due to lower oil and gas prices and reduced downstream margins. Based on my research, Chevron's downstream segment made the largest contribution to total revenues. This segment includes refining, marketing, and transportation activities, supported by strong operations in both the United States and the international market. The upstream segment contributed 45.7 billion US dollars, encompassing crude oil and natural gas production from the United States and international operations. This reflects a decrease compared to 2022 due to lower production volumes and commodity prices. Geographically, Chevron's revenue is almost evenly split, with 50.5% coming from the United States and 49.5% from the international market. The graphs below shows the revenue breakdown by segment and geographic regions for the year 2023. So let's talk about the FVMR. It's an A-STOT method of valuing companies. So overall, I'm going to highlight just the fundamentals and the risks. Overall, with improved financial health, attractive valuations. However, growth momentum has slowed, signaling stabilized expansion. Profitability and efficiency have improved significantly. Operating profit margins at 11.6% and return on equity at 11.7%, reflecting strong operational performance. However, the risk metrics have improved with lower leverage, reflected equity of 12.6% and reduced 0.4. It shows that the company is less volatile, signaling strong financial stability. For the world-class benchmarking, I'm going to highlight the profitable growth and the asset efficiency and expense control. Profitable growth improved significantly, but declined in 2022 and stagnated in 2023. This highlights challenges in sustaining balanced profitability and growth. Asset efficiency remained steady at rank 5, suggesting untapped potential for productivity improvement. Expense control improved and stabilized in 2023, reflecting a sustained focus on cost management. So we are at the numbers, and for the profit and loss statement, based on my forecast, revenue declined, and I would say this is the failing oil and gas prices amid global energy demand and also geopolitical uncertainty. Also, significant investment in African expansion and even renewable energy increases growth too. The net profit declined significantly, driven by increasing, and it's the net profit margin. The net profit margin significantly increased due to rising costs. Asset, the next fixed asset shows that Chevron asset base is robust, supported by strong upstream and downstream operations, and also the recent acquisition of Hess is expected to enhance asset. For the cash flow page shows Chevron continues to prioritize shareholders payout due to the substantial dividend payout from cash flow. So for my ratios, you can see that the EBIT margin and also margin and the return on equity improved significantly. I believe this reflects Chevron cost-effective control and operational efficiency. Also, net debt to equity ratio stability, but the revenue growth actually declined. It is actually slow, and I believe apart from the volatile oil and gas prices, it also highlights the need for Chevron to better align their expansion strategies with their profitability goals. So the depreciation, it shows Chevron wear and tear on their assets, which really affects taxable income and also the flow of cash. The CapEx shows Chevron investment in future growth, which includes new assets, expansion, and renewable energy. Despite CapEx reducing in 2024, the 2025 and beyond shows Chevron focus in long-term future growth through strategic initiatives like the Hess acquisition and also expanding their growth in growing regions. Then the free cash flow to the firm, this reflects the cash available to the debt and equity investment in operations to assets. Rising the strong revenue operational efficiency maintained flow to the firm. So this the relative valuation is the PB ratio to the return on equity, and appears to be trading at a higher value market in Asia, the world, but the US. I also forecast its return on equity in 2025, which is lower than the US and global averages, but higher than the Asia ex-Japan region. It actually shows that Chevron is relatively overvalued compared to other regions, indicating a premium valuation despite its lower projected profitability. This is another relative valuation based on the PE ratio to the EPS growth ratio. I would say on the forward 2025 to Asia ex-Japan, the world, and the US peers. So it appears to be relatively expensive, trading at 15.9x to rebound to 8.5% in 2025. As a result, Chevron 2025 PE to EPS growth multiple shows that Chevron is overvalued relative to the US peers, but undervalued relative to the global peers. Okay, I actually used the DCF to do my valuation, and this is actually the valuation I used. So I assume a risk-free rate of 3.5% and a market equity risk premium for the US market of 10%. Chevron has a relatively stable business model with a beta of 1, resulting in a cost of equity of 13.5%. Chevron's capital structure includes 4% debt to total capital of 12.5%. I use the free cash flow to the firm for valuation as it best captures the cash generating ability of the business while also accounting for capital expenditures and debt dynamics. So based on methodology, I calculate a base equity value of $215 per share. This represents a potential upside compared to the current market price of $159. I believe this valuation perfectly reflects Chevron's strong cash flow generation and disciplined capital allocation strategy. So for my sensitivity analysis, the equity value could vary depending on assumptions about future cash flows, and terminal growth rate case suggests an attractive upside. Factors such as commodity price volatility and changes in operating margins could affect the valuation. So let's go to my major risks. And I will say one is I'm going to highlight just the volatility in oil and gas prices. Chevron's revenue remains highly dependent on oil and gas prices, which are influenced by geopolitical tensions and fluctuations in global demand. Prolonged price declines could significantly impact projected cash flows and weaken valuation assumptions, creating uncertainty for investors. I believe Chevron perfect storm intensifies with oil prices and renewables through uncertainty in renewable energy transition, rising capex and cost challenges, and regulatory and environmental pressures. In conclusion, Chevron in Africa, bolstered by its infrastructure investments and the recent acquisition of Hess, significantly as a global leader in the energy market. The commitment to both energy sources ensures long-term resilience and growth. Warren Buffett's recent investment in Chevron further validates that Chevron is strong financially, and it also highlights its potential for sustainable value creation. Together with these factors, I believe Chevron is a compelling choice for investors seeking stability and growth in an evolving energy landscape. Thank you.
Excellent. Okay, so now let's go through some questions. Here's a question from Momin. What are your thoughts on the energy shift? Would it be better if Chevron sticks to its original business model?
Please, can you come again?
The question is, what are your thoughts on the energy shift? Would it be better if Chevron sticks to its original business model?
Okay, I would say it would be actually better if they stick to their original business model, because they already have core expertise in hydrocarbons, higher oil and gas profitability, and high renewable investment costs. Because shifting to renewables, I don't really believe in that, because it is really uncertain. And one question I asked myself when doing this research is, if renewables were that profitable, why didn't they shift since? Why did they wait for the pressures? So I believe they should actually oil and gas.
Okay, let's get to the next question. 1 second. All right. Next question is, this one is from Olatunji. It says, do you think the Hess Corporation deal will be completed, and what impact will it have on your forecasts?
Yeah, I believe the Hess Corporation deal will be completed, and I would say that Chevron has a strategic interest in expanding its upstream portfolio. If finalized, I believe it will positively impact forecast by boosting Chevron's production capacity and cash flow, particularly from Hess Guyana assets. However, integration costs and potential execution risks and whatnot must be factored into near-term projections. So I'm positive that the deal will be completed.
And so another question we got is, where will the growth in revenue arise from, in the US or international market? This is from Kritesh.
Okay, so I would say both in the US and international, because based on my first story, apart from the Hess acquisition, Chevron is also expanding its market into growing regions in Africa. And I believe with these strategic expansions and acquisition, it will result in revenue growth from both the US regions and international regions.
I was kind of laughing about it. They're putting up wind in Africa. I thought Africa needs real good solid energy like oil and gas, so it was kind of funny.
Yeah.
Anyway, it's kind of funny. Okay. Indra says, what are the countries that Chevron's most active in apart from the US? Do you expect some of those countries to majorly impact revenue in the coming years?
Okay, I would say Chevron is highly active in countries like Australia, Canada, Nigeria, and even Guyana. Among these, Guyana is expected to significantly impact revenue due to vast oil reserves. And yeah, I believe those are the countries that Chevron are highly active in.
Okay. Moment says, why did ROE fall so much in the last couple of years?
Why did
ROE fall so much in the last couple of years?
Okay, I would say basically because of three factors: lower oil and gas prices, high capital expenditures, and increased debt. And if you can check, that even affected the revenue, the EBIT margins, and the return on equity.
Okay. And we did have another question about Hess. They said that it seems, this is Tope John. He says, what do you think about the Hess acquisitions? It seems to be progressing slowly due to the lawsuit from Exxon. And do you think Exxon has a point that on the first refusal claim?
So please can you come again with the question?
The question is the Hess, what is the situation with Exxon in relation to the Hess deal and Chevron?
Okay, I would say Exxon is for the Hess Corporation. I really don't know what how will I put it? I really don't know what is their position with the Hess acquisition because my research is on Chevron. But I believe with Chevron strategy and all they do, I'm actually positive and optimistic about that.
Okay. So how does it feel to graduate from the Valuation Masterclass Boot Camp?
It feels great. I have really worked hard for this. An incredible 6 week, though intense, but yeah, it has been rewarding. And I would like to thank you and the entire team of the Andrew Stott Investment Research Bootcamp because it is an experience that I wouldn't want to trade for anything. I didn't know I needed this tool. I was actually in. So yeah.
That's great. And how would you describe your transformation?
Okay, I would say in this last 6 weeks, my financial analysis skills have increased. I've gained experience on valuation because until the bootcamp, I don't think my valuation, I don't think like I was, how will I put it? I don't think I was really good in that aspect. So I would say this experience like has taught me a lot regards valuation and also in the aspect of research too. I feel like now I can look at a company based on my research, based on sources, and I can like come up with something compared to before now, before the boot camp, because like I had no idea. So yeah.
And how does it tell us about your plans for the future, for your career? And did the boot camp change that, or did the boot camp reinforce that?
Okay, I would say it actually like reinforced that in so many ways. Because before now, I have always just wanted accounting. Yeah, I just wanted accounting and all. But I feel like the bootcamp have opened my eyes to like a lot of prospects um in the finance industry. Yes, I wanted to like okay shift to finance, but I really didn't know how to go about it. One, I really didn't know what to go about it. I was like, okay, I want to be a financial analyst. I want to do this. I wasn't really sure, but I feel like in that aspect, the bootcamp have reinforced that okay, I can gain experience. I can work on myself, and especially in the aspect of valuation. Yeah. So yeah. But I really don't know what I want to do moving forward. But I would say it actually reinforced my view in valuation and also in the finance industry, basically.
Fantastic. Well, you should be very proud of your success. To get to this point is not easy. As you know, many people don't make it. And your presentation was excellent. Your research report was excellent. And your style of presentation was great. So congratulations.
Thank you, Andrew.
Yep. And I'll see you in Slack. And now it's time to relax a little bit.
Yeah, thank you, Andrew.
All right, take care. Well, that was another look at Chevron, one of our finalist students who graduated from the Valuation Masterclass Bootcamp, presenting her final research report, and it was comprehensive and it was excellent. And she really went through a transformation in the Valuation Masterclass. So if you want to build a competitive advantage in company value,